The richest countries in the world owe trillions of dollars in debt. But here's the strange part. They keep borrowing even more. If they're wealthy, why don't they just pay it off? It is a fact of modern economic life that can seem, utterly baffling. The wealthiest nations on Earth, countries like United States, Japan, United Kingdom, are also the world's biggest debtors. Their national debts are measured not in billions, but in the tens of trillions of dollars, a scale of borrowing that is difficult to comprehend. This simple observation leads to a very logical and powerful question. If these countries are so rich, why don't they just pay off their debts? Why do they keep borrowing more and more, year after year, digging a deeper and deeper financial hole for themselves? The instinctive comparison we make is to our own household finances. Most of us are taught that debt is something to be managed carefully and paid down as quickly as possible. A family that continuously spends more than it earns and racks up endless credit card debt is seen as irresponsible and on a path to financial ruin. So, when we see governments doing what appears to be the exact same thing, but on a colossal scale, it is natural to feel a sense of alarm. It seems to defy common sense. Yet these countries with mountains of debt continue to have strong, functioning economies, and investors from all over the world line up to lend them even more money. This apparent contradiction is not a mistake or a sign of impending doom, at least not in the way most people think. The reality is that the finances of a sovereign nation operate on a completely different set of principles than the finances of a household. A government that can issue its own currency, set tax policy, and live, for all practical purposes, forever, is not like a family trying to pay off a mortgage. Understanding why rich countries borrow is not just an academic exercise. It is fundamental to understanding the forces that shape our global economy. Interest rates on our savings accounts, funding available for public services. The conversation surrounding national debt is often polarized and filled with anxiety. On one side, you have voices warning of a looming fiscal crisis, where runaway debt will trigger hyperinflation. So where does all this borrowed money go? One of the primary reasons governments borrow is to make long-term investments in the country's future. Think about the essential infrastructure that underpins a modern economy. Highways, bridges, airports, high-speed rail networks, the electrical grid. These are massive generational projects that cost enormous sums of money. No government could realistically finance a new nationwide highway system or advanced research hospitals using only a single year's tax revenue. It would require drastic tax hikes, or crippling cuts to other essential services like defense, pensions, healthcare. Instead of paying all at once, borrowing lets governments spread the cost over many decades. This is accomplished by selling government bonds. A bond is essentially an IOU. The government sells a bond to an investor, an individual, a corporation, a pension fund, or even another country's government, with a promise to pay back the principal at a future date, plus regular interest along the way. Beyond funding long-term projects, government borrowing plays an indispensable role as an economic shock absorber. Economies are not static. They move in cycles of expansion and contraction. During a recession, the economy slows down, businesses lay off workers, household incomes fall. As people lose their jobs and confidence, they cut back on spending, which reduces business revenue and triggers more layoffs. This creates a dangerous downward spiral. In these moments, the government is often the only entity powerful enough to break the cycle and prevent a deep recession from becoming a full-blown depression. To do this, governments use counter-cyclical fiscal policy. When the private sector cuts back, the public sector steps in to fill the gap. This can take the form of stimulus packages, sending direct payments to households, extending unemployment benefits to help families stay afloat. It can also include direct government spending on shovel-ready infrastructure projects to create jobs. All of these actions require spending money the government doesn't have because tax revenues plummet in a recession. The only way to fund this emergency response is to borrow. The COVID-19 pandemic is a stark, recent example. As economies shut down worldwide, governments in the United States, the United Kingdom, and elsewhere unleashed trillions in borrowed money to support furloughed workers, provide loans to struggling businesses, and fund rapid vaccine development. This increased national debt sharply, but the alternative, allowing the economy to collapse, would have been far worse. The debt was the price to preserve the economic fabric during an unprecedented crisis. Bonds from wealthy, stable governments serve a critical function for the global financial system. Government bonds are the ultimate safe asset, especially U.S. Treasuries. Banks, insurance companies, pension funds, and major corporations need a secure, liquid place to park cash. Section 4. When is too much? Too much. The great debt debate. Of course, this does not mean that debt is without risks, or that a country can borrow infinite amounts of money without consequence. There is a vigorous and ongoing debate among economists about where the limits lie. The primary risk associated with very high levels of debt is the potential for rising interest rates. If investors, both domestic and foreign, begin to worry that a government's debt is growing too fast relative to its ability to pay, they might start demanding higher interest rates to compensate them for the perceived increase in risk. This could create a vicious cycle. As interest rates rise, the cost of servicing the existing debt goes up. This means the government has to spend more of its budget just on interest payments, leaving less money for everything else, from education defense. To cover the higher interest costs, the government might have to borrow even more, which could further spook investors and drive rates even higher. In a worst-case scenario, this could lead to a sovereign debt crisis, where a country is unable to roll over its debt and is forced to default, causing catastrophic damage to its economy and the global financial system. This is the nightmare scenario that keeps fiscal conservatives up at night. However, the experience of countries like Japan challenges the most alarmist views. Japan's national debt is over 260% of its GDP, a level that would have been considered impossible by many economists just a few decades ago. Yet Japan has not experienced a debt crisis. It continues to borrow at near zero interest rates. A key reason for this is that the vast majority of Japanese government debt is owned internally by the Bank of Japan Japanese Citizens Institutions. This creates a more stable and controlled situation than if the debt were primarily held by foreign investors who might flee at the first sign of trouble. The crucial metric, then, is not just the absolute size of the debt, but its relationship to the economy's growth rate. Prevailing interest rate. As long as a country's economy is growing faster than the interest it pays on its debt, the debt-to-GDP ratio can remain stable or even fall over time, even if the government is running a budget deficit. The United States successfully paid down its massive World War II debts, not by running huge budget surpluses, but by growing its economy rapidly in the decades that followed. The debate, therefore, is not simply about debt is bad, but about ensuring that borrowing is used for productive purposes that foster long-term growth. This mechanism is crucial for economic growth. Public investment in infrastructure and research often crowds in private investment. When the government builds a new highway, it makes it cheaper for businesses to transport goods. That encourages businesses to build new factories and warehouses nearby. When it funds basic scientific research at universities, it lays the groundwork for private companies to develop new technologies and products, pharmaceuticals, software. These investments create jobs. Section 5. Debt as a tool, not a trap. Debt as a tool, not a trap. In the final analysis, the reason rich countries keep borrowing is because for them, debt is a powerful and flexible tool. It is not a sign of national poverty or profligacy, but rather a feature of a sophisticated modern economy. It allows for the financing of long-term investments that create future wealth. It provides a critical safety net to cushion the economy from inevitable shocks. It supplies the global financial system with the safe assets it needs to function. Viewing national debt through the lens of household finance is fundamentally misleading. A nation that controls its own currency is an issuer of money, not just a user of it. The ability to borrow cheaply is a hallmark of economic strength and credibility. Investors lend trillions of dollars to countries like the United States and Japan because they have absolute confidence that they will be paid back. This confidence is built on a long history of political stability, a robust legal system, and a dynamic economy capable of generating sufficient revenue. For these countries, refusing to borrow would be akin to a successful corporation refusing to take out a loan to build a new, highly profitable factory. It would be a missed opportunity, a self-imposed constraint on growth and prosperity. This is not to say that debt is a panacea or that there are no dangers. Debt that is used to fund unproductive consumption rather than investment, or debt that grows persistently faster than the underlying economy for decades, can indeed lead to serious problems. The political process can sometimes favor short-term giveaways over long-term investments, storing up trouble for the future. Vigilance is always required, and policymakers must constantly weigh the benefits of borrowing against the long-term risks of an ever-increasing debt burden. The key is to manage debt wisely, using it as a means to an end, not an end in itself. So, while the sheer size of the numbers can be intimidating, national debt in a wealthy country is part of the system, not a bug in it. It represents the accumulated cost of fighting wars, surviving recessions, and building the foundations of a modern society. It is a reflection of past challenges and a tool for future ambitions. The crucial question facing us is not how to eliminate debt entirely, but how to ensure it is used sustainably to build a stronger and more resilient economy. As debt levels continue to rise globally, what new rules might we need to ensure this powerful tool remains a source of strength and not a seed of crisis?